So there's a trend that's been happening in Vancouver, Fraser Valley, Toronto, even Calgary probably at this point, where basically sellers are saying, if I don't get my price, then I will just rent it out. And I think that is going to come to an end pretty soon, or at least the large majority of it is going to come to an end, or maybe not. A lot of it is going to come to an end, let's just say. And reason being is rents are falling, vacancy rates are up, and we have a very full purpose-built rental housing pipeline, or purpose-built rental construction pipeline in the works right now. As an example, I wrote an offer on a condo the other night. Okay, they had a tenant in there for $2,300 a month. And basically it was, if I don't get my price, I'm just going to rent it out. Fair enough. The issue that I see is that if this tenant decides to leave, well, they can go down a couple floors in the building and probably rent the same unit for $1,750. And it's not even a lot of work, right? I'll just move all of my stuff into the elevator downstairs and into the same unit, right? That's what's happening right now in Surrey Central. Well, maybe not exactly that, but it could happen, right? There's enough supply that can happen. So if let's just say you bought the unit in like 2022, all right? You thought your interest rate was going to be 2%. You thought your rent was going to be $2,300 a month. Well, now the rent is $1,750 and your interest rate is 4.5%, right? So if that tenant leaves and now you have to rent it out much cheaper, and not only do you have to rent it out much cheaper, you may not even find a tenant for the first month and a half, the first 2 months. I was just talking to my property manager buddy who rented out like the best location in Surrey Central, brand new build, 2-bedroom for, it was either $2,150 or $2,250. I can't remember the exact number, right? But those were renting for $3,000 a month at one point, maybe even a little bit more. And I just had a client who rented a 2-bed in Abbotsford for $2,250, more than the unit in Surrey Central. So as a landlord now, I think you're probably fine if you bought 2024, 2025, because you're well capitalized. You already knew your interest rate. You already knew your rent. There's no surprises here. But if you bought 2022, maybe start at 2023, and now you have to make a choice. Okay, be even more cash flow negative, take a month, 2 months to find this tenant, or take my, $10,000 less or 15 grand less than I thought right now. And I think a lot more people are just going to take the lower price now. So getting into this article by Dan Foch, he says, for decades, CMHC had been the invisible hand helping Canadians buy homes. It backed buyers, stabilized lenders, and injected liquidity into the market when confidence wavered. But as revealed in its 2024 annual report, that hand has shifted. Much like our European counterparts who have seen decades of declining homeownership in favor of institutional rental housing development, CMHC has begun lifting a different pillar of the housing economy, rental development. So they aren't helping homeowners as much, and they're helping people build rental housing a lot more. A lot of the real estate industry experts talk about a supply gap we could see in Canada in 2028 when the condo pipeline dries up and there's a shortage of new units. If we keep building rental at this pace, I don't think that's something we'll need to worry about. And I've talked about the supply gap a lot, right? It looked like there was going to be a huge supply gap. But the thing is, if you take a look at this now, right? Purpose-built rental housing is the green line. Look how much we're building, even though condo starts have been falling off a cliff. So we weren't building any of these, but now we've started building a lot of these. And the thing about this is as rents have fallen, vacancy rates have gone up, you might see a lot less people starting to build these, right? Because if you thought you were going to get an average of $2,200 a month rent, and now it's $1,900, maybe your pro forma doesn't make sense anymore. You thought vacancy was going to be 2%, now it's 4%. Maybe it doesn't make sense to build these anymore. So you could see this pipeline start to dry up as we go into 2026 or the middle of 2026 or whatever it is. In 2024, CMHC held $213 billion in insurance on multi-unit apartment buildings, up from $168 billion the year prior. Meanwhile, insurance on single-family homeowners fell to $162 billion. The chart below shows the long-term trend. This inversion is no short of a watershed. For the first time in its history, CMHC's book is led not by the dream of home ownership, but by the machinery of rent. And you can see the amount of insurance being given to rentals in comparison to homeowners. And basically what Dan says is that in a lot of places in Europe, it's not uncommon for like renting a home to be the norm. That is not against the societal norm. Because here we're like, oh, you don't own a house? What are you doing, right? In Europe, it's nobody even thinks, why don't you own a home? It's just assumed that you are a renter. And basically what he's saying is he believes that home ownership is going to continue to fall, just like it has in a lot of cities in Europe that are a lot older than us. They're more mature. They've had a lot more time for the dynamics of their housing market to play out and develop. He then goes on to say CMHC insured 283,000 rental units last year, and that is a 28% spike, driven overwhelmingly by the fact that CMHC's MLI Select program is one of the few ways a builder can afford to build today, which is basically you can build rental housing with 5% down, with a 50-year amortization. So because you're amortizing that loan over a much longer time frame, your mortgage payment is less and the rental numbers make sense. Homeowner loans, just 50,000, a marginal 3% gain. The visual below shows that the divergence has played out over the past decade. What began as a narrow difference has now become a wide and accelerating gap, one that is increasing at an even greater pace since the introduction of the MLI Select in 2022. And then, okay, this is the insurance book here. So you have the home ownership falling very low in comparison to rentals at the moment, and this is just soaring. So all that being said, I'm still decently positive about the market in 2028. I'm pretty positive that they're going to bring back immigration, and maybe you see this pipeline dry up because the numbers just don't make a lot of sense for people anymore with falling rents, vacancies increasing, and maybe the rental market will stabilize sometime in 2027 as a lot of this pipeline dries up. Because currently, as it stands right now, here's another chart: purpose-built rental apartment vacancy rates by construction years in Calgary. And you can see anything built post 2015 has a 7% vacancy rate, which is a very high vacancy rate for Canada. In the States, a lot of markets might be like 5 to 6% is pretty normal. To give you some context, here in Vancouver, we have been between like 1 and 2% for like 15 years. These new builds in Calgary are at 7%. So are you going to continue to see people build purpose-built rental housing when they have to write 7% vacancy into their pro forma, and maybe they were getting $2,200 a month rent last year, and now it's going to be $1,950 this year with that vacancy rate? Probably going to see less purpose-built rental getting built would be my guess. Not an expert, definitely not a developer. And then he goes on to say that the vacancy rate's going to get worse. Honestly, it would not surprise me to see vacancy rates 2 to 3x from where we are right now. We are currently in the 2% range, and 6% would not be unheard of given the setup, right? So rentals under construction as a share of the total rental stock. So BC has almost 15% of its total rental stock under construction right now, completing probably in the next year and a half. You have Atlantic Canada at 13%, Alberta's only at 9%, Saskatchewan at 7%, you get the idea. And then you have Ontario only at 5%, surprisingly. So yeah, I think based on all of this, I think you're going to see a lot more sellers opting into just selling their units at whatever the market price is, as just renting it out for another year or another 2 years is not going to be a great option for a lot of people going forward. If you have to take 25% less rent than what it's currently rented at right now when your tenant leaves, and take a month or two to find that new tenant, I think a lot of people just say, you know what, I'll just take the 10 grand haircut right now, or the 15 grand haircut right now. So yeah, you're going to short term see more pain for landlords over the next probably 18 months here, and as we get into 2027. And, maybe things start getting better as we get into 2027. Maybe a lot of that rental stock that's getting built right now is completed, absorbed, rents stabilize. We're not building any condos at the moment. And if immigration comes back, maybe you start to see some rental growth as we get into like the back end of 2027 or something like that. But I have no idea. Just here bringing you the data. Well, I guess Dan's bringing you the data. I'm just kind of reiterating it and giving my own opinions on it. But if you liked this video, make sure you like it. Subscribe, and if you want to chat with me about buying or selling in the Fraser Valley, link down in the description. Otherwise, I'm that Agent Kelly. I'm making moves to move you. Peace.